What's up, Main Street? Marcus Stern Senior here. We're at the beginning of 2026. Crazy sell-off in the markets right now. We're going to jump into, some of the reasons for the sell-off. Dow Jones hitting 50K. It's bouncing around that level. We're going to talk about that. We're going to talk a little bit about the history of the Dow a little bit. Dow Jones Theory, something that can show you why. We'll explain a little bit about that. And then also we'll talk about investing versus trading. It's a big topic. People use those terms interchangeably, and they are not the same. We are not the same. So just going to sit back a little more laid back tonight. Going to talk to you at Main Street, just let you know, help you come from one of my main missions. I help Main Street meet Wall Street. So we're just going to jump right in. Just jump right in. We've seen the markets just move crazy begin 2026. We saw a sell-off in software. It all started with Claude integration, right? Claude came out with an app with an upgrade to their tool that could do clerical legal work. And we saw services like LegalZoom and those stocks in those sectors take a flush last week. They just went down as we saw that AI could replace that sector, replace some work in that sector. Then we saw earlier this week, we saw disruption by altruists and the integration of an announcement of their tool, Hazel. Full disclosure, me and my firm, the ABC Squared, we use altruists as our custodian. But that really, really shook the markets. It shook the financial firms, fintech firms. We saw Charles Schwab, we saw Raymond James taking really big hits after the release of altruists. Altruists are true disruptors. Big shout out to Jason Wink and the team over there, doing big things. You'll hear more from them. But one big thing with altruists and Hazel's here to help advisors like myself serve folks like you all. It's a great tool. And we also saw earlier this week with the data that came in. So we saw data that came in, the jobs report, and revised jobs reports that showed that we actually lost more jobs last year than was reported initially. Once we got this data in, we saw the housing data was really weak. The stock market was just not prepared for that today. So it seems that we've been able to find areas to hide in. There are areas in the stock market that are growing, but today was just a really, really rough day for investors all around the globe. You gotta stay focused. You gotta stay invested. Okay, don't go rushing. Don't go out making any brash decisions inside your portfolio based off one day. Okay, 1 week or even 1 month. But we'll get to that later. That's investing versus trading. All right. So, like I said, we're seeing this massive sell-off in the SaaS, software as a service area. So, like I was mentioning earlier, you have areas like where software can replace paralegals or assistants. So we saw Salesforce and Adobe and companies like that just sell off. One thing to looking at is okay, so these AI agents will be able to come in and replace some of this work, but some of these companies that have stickier relationships, they have the data with some of these providers, they have large enterprise systems with these providers. I speak about the model and how this stuff actually works in an earlier video. I can put the link in the description where we go deeper into the SaaS apocalypse that just happened a couple weeks ago. But for now, just knows that it was based on a model where revenue is charged per seat, and when you lose the seats, you lose your revenue. So henceforth, they see the revenue leaving Salesforce and their peers, not just time Salesforce, but other peers, ServiceNow, other type of companies that provide services that can be eliminated by AI or AI software. So, like I said, then we saw the altruist news. With the altruist news, we saw the move where people were worried about they won't need their financial advisors anymore. I think this is similar to, robo-advisors when they first came out years ago. There were people who were worried that they were going to wipe out the financial advisory industry. These tools will revolutionize the financial advisory industry as well as other industries. And there will be people who will use AI eventually completely for their financial advisors. More power to them. But there are going to be people who value the tools and value that financial advisors bring, mainly the personal touch, the stickiness and deepness that we can go into the actual human relationship. These AI and these advisors won't realize when not to panic sell. They'll be trading like algorithms. Algorithm trading, that's a video for another time. So if someone wants to, if y'all want to hear more about algorithm trading, just let me know. Drop a comment in the video below. But so like I said, these AI tools will come in and integrate. You have to think back when Robinhood first entered the scene. Robinhood came into the scene as a disruptor, and they had free trades. And this was back when companies like Charles Schwab and Fidelity, they were charging money for a trade. Sometimes $5 for a trade. And for people who are making a lot of trades, this can add up. So Robinhood came in and dropped the floor. Everyone thought Charles Schwab and these companies would be destroyed, but these companies just adapted. They have very huge balance sheets. They have a lot of leverage to pull, and they have a lot of money under assets under management. So they have a lot of tools that they can activate. They adjusted. Robinhood is actually one of the companies that was hit the hardest with these fintech innovations, but that's kind of tied to crypto as well. As Robinhood has been played as a proxy to crypto. So as you see crypto go up, you see crypto go down. You see Robinhood move. I actually have another video on crypto, Bitcoin. When I speak of crypto, I'm usually only referring to Bitcoin or the blockchain. The other stuff is just way too much to go into with it. Not necessarily a recommendation for crypto or blockchain, but if you want to learn more, there's another video that I've already went deeper into. I'll leave a link in the description. But for now, Robinhood, fintechs, tied to crypto. When you see crypto going down, you'll tend to see you see these companies going down. So we saw Bitcoin really get hit pretty much this whole year, pretty much since about October at the end of last year. It's been cut in half, like 125 to 60. And in that move, Robinhood stocks been hit really hard as well, especially in the last few weeks. So we see these moves, we see money coming out of fintech, these AI software stocks, as people are looking for things to replace them. Investors, money managers, they're trying to figure out what industry can't be impacted by AI now, right? We're like, what can AI come in and disrupt? What hasn't it already disrupted, right? We saw it hit the Microsoft and stocks like that. What has it not already hit, or what hasn't already been impacted? What's the safe play? So people think, I don't know, maybe a safe play. We see a lot going into industrials. Industrials are up this year, materials, things like that. Energy's up this year. So we're seeing a rotation. So the money that's leaving AI and software is not completely leaving the market. It's just being redispersed into different areas. We're seeing it going overseas. We're seeing, well, we saw it going into gold, but gold has kind of leveled off, as I said, if you play. But we see money is being reinvested. A lot of money going into ETFs, just like indexes. But this is a time where stock picks will matter. You can't just go out and just say AI and think that you'll have a stock that's going to win. You have to know what you're doing, do your research, check the spending on these companies. The spending levels really matter when you hear CapEx. How much are they spending on capital expenditures? How much money are they spending? And what's the return on this investment? ROI, return on investment. How much are they getting back for every dollar they put in? If I spend $1, am I going to get back $1.50? If I'm going to get back $2, am I going to get back 98 cents? If I'm going to get back 98 cents for every dollar I spend, that's not a good investment. So people just wonder how much exponentially you're getting back for every investment that you're spending. You don't want to lose money on investments, and they also want to see, they're just interesting with the type of funding that's been going on with the AI move as well. We have Google that just introduced 100-year bonds. So I don't know who's going to be here for 100 years. Maybe these are tools that can be used for endowments or for, I don't know, a family legacy type investment too. I'm not sure who's going to accept those bonds, although life expectancy is up. That's a whole nother topic. Not one I'm going to cover, life expectancy, but I can help you with how much money you need to have to live with this new expanded life expectancy as well. So it's just another thing where you may need to talk to someone. So talking about AI, software sell-off, the whole market sell-off that we're seeing right now, people are just worried that the whole AI play is flawed, right? So if the AI play was flawed, people are worried about the Mag 7 and the move out of software. We still see moves into semis, people are still making chips. NVIDIA is still getting chips. So some of those companies have seemed to perform well. Some of these chip companies have backing by the government as well. You can think of Intel and their partnership with the government. You can think of other companies that have made commitments to the government. And just know that there's a balance. These things are normal that we're seeing right now. You see markets go up, you see markets go down. These are pullbacks right now. So you see 10%, that would be a correction. You see something going to 20%, that would be bear market. That's where you start to get to maybe recession talk, where people start thinking about those type of things. But we're not there. This is just a rotation right now, volatility. You never know what moves the markets from day to day. Never know what will move the market from day to day, I should say. It could be one tweet or one post, or it could be economic data, which is another thing that we've gotten. Like I said, it's coming in just lowering the chances of a rate cut, depending on which camp you're in. Or some say perhaps we may have to have a rate hike if the economy is running so hot and inflation is out of control. We need to temper that down. We'll see. We also still have the tariff interplay. We have Iran, which is pushing oil prices up a little bit. So we see that increase in inflation. We see that increase in the oil stocks right now. Just a lot of moves aside. So the stock market right now, if you've been invested in, say, since COVID, you haven't really seen this. But this is natural. This is a rotation. This is what happened last year. I don't know if it's going to be the same duration. I don't know if we're going to have the same V-shaped recovery. But if you remember last year, at the beginning of 2025, there was a lot of economic detoxes. We had geopolitical petitions. We had to figure out if we were going to get the legislation enacted with the one big beautiful bill, tax reform. We had to see if the tax cuts would expire at the end of the year. We obviously had a government shutdown at the end of the year, or in the middle of the year, excuse me, and a later one, which we're kind of partially in right now. So there's a lot of stuff happening right now. And we have a debt and a deficit that are just expanding. Interest rates are high, and the Fed they're on pause right now. They cut rates at the end of the year, 75 basis points, 3 cuts, but they're on pause for now. We have Kevin Warsh coming in. That seemed to have routed the markets. That was also around the same time as the software sell-off. So those things happened on pretty much the same day. It was just a big shake with the market. What I'm saying is, what we're seeing is natural inside the market. We actually witnessed it last year, even as the market was up 18 to 20%. We saw rolling recessions in certain areas. We saw areas that were down, areas that were up. This brings me to my next topic. So I said you can kind of tell when these things are coming, right? There are movements, there are different theories, right? One is Dow Jones Industrial Theory. You hear people talk about the Dow Jones. All right, what is that? It's a stock index. Started by Charles Dow, Edward Jones, another man, Charles Stressenberger. That's quite the name, or Bergstresser. Charles B. But, so Dow was a journalist. Edward Jones was statistician. Back in 1896, they started this index with 12 companies that pretty much encompassed the U.S. Economy, different sectors. Obviously, as the world changes, the companies change, the sectors change that represent the U.S. economy. Right, railroads was a much larger part in there than it would be today. The Dow Jones now has expanded to 30 stocks. So it's one thing we hear people speak about the Dow Jones all the time. It's only 30 stocks in Dow Jones, but it represents the total economy. And one big thing with Dow Jones is the Dow Jones Industrial Theory. So Dow Jones Theory, transportation theory. So inside of it, you have Dow Jones transports, part of the economy and stocks that move the goods. Other side, you have the industrials, the parts that are making the goods. So if the stock market, so let's take for instance where we saw 50,000 in the stock market. It might be 50,000 now, depending on the time of this video that you're watching. But on the Dow Jones. But when it hit 50K, what we saw was the Dow Jones transports were down. So those companies were down. Why would they be down if the stock market's that high? Okay, so that's because they don't have things to move. There are orders being made and orders being moved, or there's something delaying the movement of those orders, right? So you need the transports to be transporting items. You need the industrials to be creating items and goods to be transported to the consumers. That shows that the whole cycle, economic cycle is working. People are consuming, producers are producing, transports are moving the goods to consumers into households. So when both of these things, when the industries that are producing goods and the ones that are transporting them are up, and you see the economy up, like the Dow Jones up, stock market economy, two different things, but and you see the Dow Jones up, that lets you know that this is a more healthier move. So and what we saw recently was a state where the Dow Jones was the transports were and are in bear territory. It took a hard hit today. Most of them, FedEx had their investor day recently, and that helped them a little bit. But in general, we saw the Dow Jones investments or Dow Jones transportations have been in the bear market here lately. So think about, like I said, companies like FedEx, UPS. These are just some of the Dow Jones companies. So Dow and Jones, they would read the reports, take them to the New York Stock Exchange. That was your thing back then. That was how they started and just grew into what we know today as the stock market in the U.S. Or the Dow Jones industry. Another thing to note is that people worry about bubbles, and you should be concerned with your investments. You know what you're investing in. We've had several of these. Have a lot of these. 1907, we had a big hit. The government responded with the Federal Reserve. 1929, obviously the Great Depression. That many people remember. Well, not living people remember, but we've read about the Great Depression, one of the greatest financial depressions in history. That was started by speculation and bank runs. We created the SEC. There was a lot of margin calls in there too. So we created the SEC after that to help with governance and regulations of traders, because the stuff that they were doing while it was terrible, it wasn't illegal back then. All these margin calls, insider trading. Then you have 1987. So in 1987, you just have also it was another incident where it was somewhat of a scare. People started kind of running on banks. You had a bad day on Thursday and Friday, and it just kind of carried on. But there were definitely underlying issues inside of the economy. We had run it hot for a while. The Reaganomics had run it very hot. So there were other actions inside that. Then you had the 99, 2000, 2001 bubble, which people like to compare this time to, where you had the dot-com bubble. Anything and everything that was dot-com was going up and going up and going up. Stuff that didn't even make sense. You had to build out. I was speaking with the board group that I meet with earlier, an advisory board. We were talking about just the investment, is the bubble, what people were seeing, what they're talking about with their clients. And I just mentioned, back then people weren't really sure. They really overbuilt, and we'll overbuild for AI too. But they built, I think it's 5 times the amount of fiber that goes around the world. Now just put it like with AI, we'll probably only end up building 2 or 3 times as much capacity as we need. Same thing happened with railroads. When railroads came out, we overbuilt railroads, which is ironic because now we're trying to get the railroads connected where we can have a cross country transit. But that's a whole nother whole nother story. But so like I said, you have the dot-com where you have overvaluations, you have cheap money. It's also a thing that's usually accustomed to all these things, is cheap money with low interest rates. So you had cheap money and the bubble burst. You had a lot of things that actually didn't earn any money. You had things that just, like I said, just said .com and the stock price went up. Kind of like you can just think about things that just said AI and the stock price went up. Then we have 2007, 2008, the housing recession that was built off of those structured notes, those terrible mortgage-backed securities that were created. The movie The Big Short's a really good explanation of all that. But basically what they were doing is they were lending money to people who possibly couldn't pay back the bill. Let's say that you make $10,000 a year, they would sell you, and these numbers are arbitrary, not exactly real numbers, but the way that people couldn't pay them back or not. So say they would sell you something for, say you were earning $10,000 a year, they would give you a loan for a home that's $500,000, a $500,000 home, something that you couldn't pay off in 50 years if you wanted to. And they would just approve it. because they were just trying to get those loans approved because they were catching fees on the backside. So they were taking these loans that were trash, packaging them with other loans that were good, people who were credible, people who would pay back their loans, putting them inside these notes, putting them all together out in there, and then going out and getting insurance on these notes, selling them to people. Sometimes they were also shorting the same notes, right? So they were playing both sides of the fence. They knew these notes were trash. They knew that the housing market was going to, they knew that eventually the bubble would pop. They just were figuring out who was going to get caught with the bag. Who's going to get left with the bag? That was the question. So that's 2007, 2008, the housing market, and it was a terrible, detrimental time. And this time plays into a lot of investors now, because a lot of people who are investing now were children then, so they remember the stress and the pain that they saw from their parents or people losing their homes or not being able to move into their home. Another big thing with that is a lot of those loans they made to the individuals were adjustable rate mortgages. So in my opinion, and there are various opinions on this, you want to get a fixed rate on your mortgage. That way, when the interest rates go up, or even when interest rates go down, your mortgage stays the same. These people are getting financed, like I said, they're $10,000 a year paying for a $500,000 house. Maybe they got financed at 3%, but then interest rates started going up with inflation, as we saw, and these mortgage rates could just shoot up 1% or 2% in a month, 3%. I know people personally who just saw this same thing happen to them, so their payments would change like drastically, and then their houses weren't worth what they paid for them, so they were underwater. People would just leave their homes. So 2008, 2009, the housing market bubble, it was a terrible thing. A lot of people lost a lot of money, lost their homes, just probably lost relationships. It's a bad time. Then we get COVID, 2020, right? The world just shuts down. And that kind of stuff happens, they're just events that you can't plan for. It's always going to be one of those. They're just going to happen. World just shuts down. Um, in response to it, the government stimulates the economy with a lot of free money at low interest rates, low to zero interest rates. People go out and spend this money. Inflation just begins to run wild. We do not catch inflation in time. Chairman Powell even said that they mistimed it and probably shouldn't use the word transitory. Although some of those things may be transitory now. Maybe they just had the time frame wrong on the transitory inflation. But so we saw inflation go up to record highs, levels we haven't seen in 20, 30, 40 years in the last few years. So inflation goes up like that, and your price goes up 20% on something. Um, Even when inflation numbers come down in the following years, and they say inflation is 2.5% compared to estimates of 2.5%, people are happy about it. Inflation instead, that's still 2.5% on top of whatever it already was. So people are feeling this pressure from prices. So inflation, prices, and then we just saw, so we're still feeling that bubble. We're still working through that right now because these things take time to recover. That's where we're at now. We're at the point where fiscal policy has to figure out how to, we've been working on bringing inflation down, how to cap this inflation. Are we going to grow out of this economy, or are we going to have productivity that outgrows the inflation? We've had some tremendous GDP, but we also have tariffs now, so that's a whole different dimension than we experienced before. So inside of the tariffs, you just get a whole different experience. You can have a whole different level that we really haven't had a high level of tariffs, I should say, since the early like 1900s. But we've had tariffs. President Trump enacted some tariffs before in his first term, and President Biden left those tariffs. So he just took the tariffs. President Trump has just taken the tariffs to a different level now. Another thing that can move the market is depending on what the Supreme Court of the United States has to rule on tariffs, and the tariff ruling that is imminent. We're expecting it soon. So that's just kind of how you get to these bubbles in kind of different ways, right? Some things are different inside these bubbles. One, the speed of information, right? So we have so much speed that moves inside information. Inside two is after all these moves, all these scares, these depressions, there were tools implemented to help curb future events. Uh, some say they made them better, some say they made them worse, right? One of the things that like in 1929, the Fed was there, but the Fed made the wrong move. The Fed didn't. The Fed tightened monetary conditions when they should have loosened monetary conditions. So just because you have the institution there, they still have to have the people there to make the right decisions, right? So you had the Federal Reserve, like I said, in 1929, but it still didn't stop because they made the wrong moves. And hindsight's 2020. You know, the Federal Reserve chair at that time had never experienced anything like that. But here we are, 2026, uh, coming into a new Fed chair and a new government uh, in the middle of what may be a bubble, the beginning. I don't know. We'll see. Stay invested is a big thing. So that just brings me to my next point. Investing versus trading. Way too many people just say investing and trading like it's the same thing, and it's not. Okay. So think about investing like gardening, farming, right? Like you got to plant the seed. Actually, first you have to go in there, you have to get your soil, you got to pull out the weeds, you got to get all that stuff right. Then you plant your seed, then you fertilize it, you do all that stuff, then you got to let it grow. You got to tend to it, you know, you go out there, tend to it, you pull the weeds. When you first put it in there, you got to do a little more work, right? Before it gets established. Once it gets established, you just pretty much tend to it. It's a tree plant, you just go out and prune it maybe once or twice a year, once it grows up to its maturity. But while it's growing, you have to make sure the trunk is stable. You have to make sure that uh, things aren't out there. You make sure that that's messing with the tree. You just have to make sure that it's nourished. But as it grows, it can take care of itself a little bit more. So that's like investing. You know, you want to take your time. You want to make a move. You want to invest in something. You want to have it. You want to make something. You want to buy something that you can hold 3, 5, maybe 20 years. I don't know. Plus, I'm not just talking about investing in stocks or bonds. When you invest in anything, a lot of people invest in homes. Their homes is their largest investment. But yeah, I mean, you're not buying your primary home and moving out of it in 6 months, unless you're, you know, a person who flips houses. But most people, you know, think about that's an investment. You invest in your house or you invest in yourself, you invest in your education. Those are things that take time, those things that you put the work in at the beginning, you get the results in the back end. Investing. You invest in your relationship, you invest in a lot of things, right? So those are investments, longer commitments. Trading, on the other hand, is something that just happens fast. Boom, boom, boom. Trading's like speed dating, I guess. I don't know if that's still a thing. I guess. I think the 40-year-old version every time I think about speed dating. That was fun. But yeah, so those are like moves that you're in, you're out. I usually consider it less than a year that you can be in a trade, right? You can see something that you like now, it could be something that you like later. But a trade can be a minute, a second, a day, an hour, months, a year. It just depends. Uh, Depends on your time frame when you're jumping in, when you're jumping out. One thing I will say is that you should be knowledgeable in what you're investing in, and you should be knowledgeable of what you're trading in. The same amount of knowledge, whether you're investing in something or whether you're trading in it, because it's your money both ways. So you need to know what you're investing in. What you're investing in, you need to know why you are investing in what you're investing in. What's the reason? Why am I doing this? Because the market's going to get choppy. Look at where we're at now. Don't go out making drastic moves. If you're an investor, you're not out making drastic moves in your portfolio right now. Maybe if you balance some, maybe if you reduced a little bit of risk, maybe you've gone a little bit less risk on, more risk off. I got a good video on that. I can leave a link for it in the description, risk on versus risk off. Um, and you're just reducing your risk, you're reallocating some of your assets. But if you're a trader and you see this stuff, you're jumping in, you're jumping out, you could miss time it badly. You could get it timed perfectly, make a lot of money. Could. You see those people on TV, like the one or two who actually timed it perfectly and they like write books about it. But generally you see people who tell you don't try to time the market, especially trades. Like stay in the market. Time in the market dwarfs time in the market all day, every day. The longer you can stay invested, generally the better your returns will be. Why is investing going to uh, over the long run work out better for traders? One, it requires a lot of time to trade, time, effort. Unless your job is a trader, if you're a person who has another job, it's hard to trade and have a job and a life because it just takes a lot of time to watch the market, see how things move, especially in the markets we're in right now. The markets, today, for example, the futures were up in the green to start the morning. Market is down a few percent, just a deluge, just a flush. I usually see when the futures are down in the morning, the market ends up. It's very interesting juxtaposed. But if you're not in there and you're watching this stuff, you can make the wrong trade. You could have bought this morning, sold this afternoon. That's not how you want to do it, unless you're short in the market. Different story. But mainly you want to invest, or if you want to trade, just make sure you have the time, make sure you have the knowledge, make sure you know what you're trading, make sure you know your why. So investing versus trading, just the basics of it. If you're using your retirement account, your 401k, something like that, you do not want to trade inside of that. That's just not prudent. You probably want to invest in that. Get a different pool of money for trading if you want to trade, but not inside your major retirement account. It's just prudent, right? Also, before you get into investing or trading, if we're talking about stocks or bonds, you need to make sure you have the basics set up. I got a video. I'll leave a link for it on the basics of investing, the blocking and tackling, the building blocks. I can leave down in the description. But so there we also have it. So we talked about a lot here. Talked about the market sell-off earlier. Talked about Dow Jones, a little history on Dow Jones Theory. Maybe it's one of the things that you can see. It's how you'll know if the market is going to move, or if you know if goods are moving in the economy. Spoke a little bit about inflation. We did a little tour about the history of some of our economic failures, uh, recessions, depressions. Some of the five big ones: 1907, 1929, 1987, 2000, 2001, if you want to call it, and then the 2020 COVID crash. I missed the housing market. In the housing market, we talked about the housing market crash as well. So 2012 as well. So we covered all those. Just some general things to remember when we're talking is remember that if you're investing, stay invested. These are opportunities. If you're a long-term investor, if there's a stock or a bond, or even, I don't know, if you're investing in property like something you see come down that you think is going to be a better investment in the long run, take a shot. But know that anything you're investing in, you need to give it time to grow. It's going to ebb and flow. It'll go up, it'll go down. Eventually, it should go up and to the right. Right. Don't be intimidated about these stats and these numbers people are talking about. Come get some education about it. If the stuff sounds tricky, one of my main things, like I said, I do this. I help Main Street meet Wall Street, and I do that with just disseminating information to people. So you can check out my channel, subscribe, like, share. I'm here to share a little bit about what I do. Like I said, this is me by night, but by day, I'm a financial advisor. I have a firm up there at the ABC Square. I do financial planning. I love the markets. I love financial literacy. That's one of my big things as well. So if you need help with that, give me a shout out. Remember, the market sell-off today. Know some of the reasons why. I know if you want to jump into some stocks, think about whether or not one of these AI stocks that we saw in the sell-off can be disrupted and completely eliminated, or will it just innovate and continue to grow? Maybe those are the ones you want to invest in, the ones that will continue to grow versus the ones that will be eliminated. Remember the Dow Jones, 30 stocks. It's old, 1896. Dow Jones Investment Theory, the transports. Watch those. And when you hear people speak about it, because part of my mission is to help people understand the stuff you hear when people don't want to go deep and diving into this information. Let me know what you want to hear, Main Street. I'll help you to the best of my ability. I will be bringing on other folks to chat with me, so there'll be some other conversations where we're going deep as well, sharing some other things. We're going to bring some guys on, talk about some crypto, just the markets, different things, some things that I want to give you the information so you can make your own informed decision. I'm not going to tell you what to invest in on here. That's what I do in the daytime. We can figure that out. Here's just giving away information for the masses, people who want to talk. Like I said, the data, we spoke about data, the jobs data, what that means, why people are thinking maybe or not we'll have more or less rate hikes, whether this economy is running hot, whether the economy is not. We didn't even jump into immigration and the role that it plays in this right now. With the job market, see, that's another thing. Let's just take a second in that. immigration in the job market, inside the job market. So typically you need a lot more jobs. We spoke earlier about jobs and the level of the jobs being revised down. But with immigration now this year looking to be a negative for last year, net immigration, you're losing a lot of jobs. A lot of immigrant jobs were filled in like farming roles. So you have a lot of people out here producing your food. Those roles are gone. People who have to fill those roles that aren't being filled by AI are going in there at higher wages. So you're feeling that come through the immigration effect. You're feeling that come through in your prices as it costs more to get this stuff off the field from the farm to the table, per se. It costs more to get it from the farm to the table. And every little step, it costs a little bit more. We're all paying a little bit more in the process. So that's how immigration impacts labor one way. You also have a lot of people who built houses inside the industry, and a lot of construction jobs inside the industry. So now you're having to pay people more to do that as well. So you're going to see housing inflation. That's another reason why you see housing inflation. But housing is also a big part with demand. So we lack supply, and the demand is there when the interest rates are going to be right. People are worried about interest rates. That's a whole another tricky interval. Then we spoke about investing versus trading, the difference, the moves. And lastly, I just want to share, like I said, Marcus Sturman, Help Main Street, Wall Street. I do have a partnership with Monarch Money. Um, it's a tool, it's a budgeting tool, a personal budgeting tool that I use sometimes with my clients. We can work together. It's a good tool. They can use it. You can share it with your partner. You and your partner can share it and see your budget live and live in color when it's happening. You can share it with your financial advisor. They can log in as well. You can all take a look at it all in live at one time. It uses AI to help integrate. It's a great place to see all of your accounts in one place. Helps with can I afford to make this payment right now? Not payment, can I afford to buy this right now, or should I wait? Do I need to move this money here, or do I need to move it there? So it's a really good tool. I'm gonna check it out on the desktop. It has a great app as well, but you want to go set it up right on the desktop. It's a good tool. So again, it's Monarch Money. I'll leave a link for Monarch Money in the description. If you use the link I leave in the description, I can be compensated for that. So full disclosure, but Monarch Money is a good tool. The link will be for a discount. You can start a 7-day trial. You can get 50% off for first year. But once again, Monarch Money. So yeah, that's check out my channel. I've got a lot more stuff already on there, and there's a lot more to come. Marcus Sturman. There it is, my name. Firms, the ABC squared. What I do. It's right there. Got any questions? You want to chat? Got any video ideas? Share this with someone? Let me know. Check it out. I appreciate your time. Thanks for joining me this evening.